you can see on the screen the topics that we are going to cover in this final session, which is very, very important, central to the good, let's say, to the good and legal management of the funds. And for that, we are joined, Dirk and I, by Lenka from our financial unit, Lenka Nielsen, and also by Oana Mantzog, some of whom know her, and Rafael, the head of unit for unit C3, which is one of our audit units. So Rafael and Oana together will cover the audit side of things. You can see eligibility, VAT, co-financing, technical assistance, decommitment, exchange rate, you name it, we are going to cover it in this session. The floor goes directly to Dirk for the first part, which is about eligibility and forms of grants. Over to you, Dirk.
Yes, next slide, please. You can hear me?
Yes, we can.
Yeah, okay. Before I start, well, those that can do multitasking, they can have a look into the chat. My sincere apologies. On question 4 in session 1, Anna answered correctly the question, and I answered a question supplemented by Maury, a question that was not asked. So sorry for that. Now, eligibility, we start with ETC, but we will jump between ETC regulation and CPR regulation. The hierarchy of eligibility rules is set out in Article 37. That does not change. What changes is that what we had in 1420, you see it on the left side, the delegated regulation was incorporated into the regulation. So there is no secondary legislation for ETC in that respect. That was done quite in a hurry, but okay. So it worked well, and it survived quite substantively the negotiations. Very important, Article 37, paragraph 2, the hierarchy of eligibility rules that apply to ETC programs. So the first level are the EU rules, meaning those set out in the CPR. So we will jump to the CPR later on. In the ERDF, there are also some rules, and also, well, it's not exactly eligibility, but the scope of what the ERDF can do is set out there, and then also these rules in ETC. On the second level, so what can the programs do in areas that are not covered by the first level, the EU rules set out in CPR, ERDF, and ETC. There, the Monitoring Committee, and this is slightly strengthened compared to the past, the Monitoring Committee can only establish additional rules on eligibility of expenditure for the Interreg program on categories of expenditure that are not covered by those provisions. So where the CPR or the ETC has said, well, what means indirect cost? What means office and administrative costs? That's it. On these areas, the programs cannot add additional rules. And so something which is not covered, as we saw last year, there were no rules at EU level on whether the costs for events and traveling that could not happen because of COVID, this was not covered, and there the programs were allowed to establish program-specific eligibility rules. On the second level, those rules then cover the whole Interreg program. You cannot adopt rules that only apply on one side of the border. So that's for the second level. And then there is still, as in the past, a third level on outside these rules, you can have national rules of the member states. This concerns mainly the co-financing, some co-financing rules or technical rules. Of course, how to build a road in Germany is under German law, and the road on the other side in Belgium or the Netherlands is built under the technical norms of that member state. Next slide, please. So, as I said, there is this hierarchy of rules. The first level are the EU rules, and we start and now jump to the CPR. We are not talking about Article 46, which talks about reimbursement and forms of support between the Commission and the programs. That's a different cup of tea. Here we talk about 47, 48, following the forms of support from the programs to the projects. And there you can have grants, financial instruments, prizes, or combination. And so we go to Article 48. We have three sorts of simplified cost options next to real costs, which also covers contribution in kind and depreciation. So three forms of SEOs. That's as in the past. You can have a combination of these four forms. And what was added during the negotiation as point 5, even between the programs and the projects, you can have financing not linked to costs, but provided such grants are covered then by a reimbursement of the union contribution. So you go back to Article 46 and 89, and then the appendix to the program template has to be filled in. So when you have A to D plus E, the combination, there is no room to fill in the appendix 1 or 2 to the programs. On general terms, there is an obligation that any operation below 200,000 has to undergo simplified cost options. Now we come to the next slide. And to establish, thank you, to establish the three forms of simplified cost options, you have 5 methods. And in big red, you have the draft budget. Well, it was introduced in the previous period by the omnibus. This is not a 4th simplified cost option, but it's a method to establish any of the 3 simplified cost options. And in the CPR, the threshold is any operation between below 200,000, and the draft budget is established by the body selecting the operation. That in Interreg would, of course, be the monitoring committee. So this provision doesn't fit for the small project fund. That's why we have, you see it a bit lower on the slide, in Article 56, that where the public contribution to a small project does not exceed 100,000, a SEO is obligatory. And in paragraph 6, the second subparagraph, that's the specific rule on small projects, which are not operations, as said already several times today, and where we needed a provision in order to make the draft budget technique also available for the small projects. And this is then set fixed ex ante, not by the body selecting the small project fund, the monitoring committee, but of course it has to be established by the body managing the small project fund. Next please. So this is still in the CPR. This you can read carefully later on. I concentrate on the red text, which comes from the ESF, which is more or less new flat rate of up to 40% of eligible direct staff costs, and so you have real staff costs direct, and all the rest can be covered by this 40%. That's important for maybe research projects where you have quite intensive staff costs, which you cannot really cover with a flat rate. So you have the basis to calculate the 40% in real cost, and then the 40% of that amount covers all the rest. It covers the indirect staff costs. It covers all the cost categories we have in the specific provisions in the ETC regulation that sets out what are the eligibility categories for ETC. So it's a general rule. You cannot apply a flat rate on basis of another flat rate. So you have something real in there. But I say this under control of the Interact colleagues who are much more expert on SEOs than I am. Next slide, please. Yeah, there are two specific issues on eligibility. And for VAT and revenue. On VAT, you see on the left side the situation for 1420. VAT is not eligible except where it is non-recoverable. Double negation, that is also quite complex, and it created a lot of interpretation. So the Commission had proposed something simple, and it became a bit more complex during the negotiations. So on the right side, you see that still the starting point is the following costs shall not be eligible. And one of the examples is VAT, and then come not one exception, but 4 exceptions in the final text. Operations, the total cost of which is below 5 million, and above 5 million, where it is not recoverable under national VAT legislation. You see the green text on both sides. That's what we had in the past, but it's only for the operations above 5 million. And this green text you do not have for point I. For the operations below 5 million, you do not have to do this consideration about what is recoverable under national VAT legislation. So yes, you may receive it twice, but that's what it is. And the final point, point 4, is, as we said several times today, small project funds are operations, and they normally are above 5 million. So in order to shield the small projects inside the small project funds, we had to set out a specific rule. So value-added tax, that's what it means, is eligible both for a small project fund as such and for any small project under a small project fund. So the small project fund manager does not have to have any headache about what is eligible by whom and whatever. No, both the fund as operation and each small project are fine. The VAT is eligible. And on revenue, we had, you see it on the left side, we had a long Article 61. We had a very long Article 65.8 with many sub paragraphs and so on and so forth. Revenue is discontinued. Any consideration at EU level on revenue generated by the project is out of our monitoring. So if national rules still have to consider that, that's your problem, but at EU level, all these complex things are done. So I hope this is really a simplification method. So revenue is out, and nobody has to discuss with us anything on revenue. It's just not an issue with regard to eligibility for the funds. Next slide, please. What do we have here? Yeah, this compares what we had in 1420 in the Delegated Act and what we have now. You see the general principles in Article 1 and 2 of the Delegated Act was taken over, the only exception is that well, gifts are not eligible at all. Well, one member state insisting on that was handing out gifts, at least to me. So, well, that's what it is. You are never protected against some kind of surprises. So you see most of the right, well, the right side of the slide is blue. The only change on the general approach to ETC eligibility rules is this detail on gifts. Next slide, please. Well, you can imagine it's not possible to set out all the details of the different cost categories. There was one question whether there is a difference of costs and expenditure. No, it's not. It comes from the previous regulation where that article in the ETC regulation was mixing it up, and then the delegated act had to take it up. But there is no difference in meaning. It's all about cost categories. And on staff costs, we try to simplify. It looks as if it's the same as in the past. It's a bit simpler, but I cannot set out in detail. What is new with regard to the category office and administrative costs? There is a new flat rate based on the gross employment costs as set out in Article 40. On travel and accommodation costs, that was a bit well, it was not a bit, it was quite complex, whether you traveled outside the program area, inside the union, outside the union. That's done. It's simplified, and there is also a new flat rate of up to 15% of the direct staff costs that can be done for travel and accommodation costs. So the colleagues in Artt and others traveling to Brussels can use the 10 trip tickets for the STIP, because this will not be controlled anymore if you opt for the flat rate. External expertise and service costs, equipment expenditure, almost no changes. And what we were not allowed to do in the past, because it was not listed in the empowerment provision, so we added it now, is costs for infrastructure and works. And this is completely new. Of course, this was already eligible, but it was not specified in the delegated act. Next slide, please. And eligibility has many aspects, eligibility in time, eligibility on substance, and one element is eligibility linked to location. And here you see on the left side, we had Article 20. It was said in principle, you can spend in the union part of the program area, and you had a lot of conditions and ceilings and so on. It's all done. So outside the member states, including outside the union, is possible because we integrated the external cooperation into the regulation. So a third country, partner country, OCT, which is defined as part of the program area, you always can spend money there. The only condition is that it serves the purpose of the program. Only when you want to spend ERDF outside the program area, and it doesn't matter inside or outside the union, you still can do it without any limitation, but then the MA has a right of veto. So, and as this was a big issue for one program, so Greenland will be in the program area of Northern Periphery. This does not apply. So you can spend ERDF in Greenland without any limitation. The monitoring committee just has to approve it, and you don't even need the veto of the managing authority. You would need that only for Alaska. So to put that example, what was mentioned already in the morning, it was put in this article. The difference of opinion between the MA and the audit authority is limited to the eligibility as such of the operation. This is for the MA listening to the monitoring committee, whether a project should have been selected under the program. So this does not take away a iota from the competence of the audit authority to say, okay, but this expenditure is irregular, or you did bad the procurement and so on. So there the managing authority has not the last word. It's just limited to the eligibility as such, because this is the core task of the monitoring committee, and there the audit authority should be a bit more shy on that. So next slide, please. And that's not for me. See you soon.
Thank you very much. Thank you for going through that quite challenging explanations. Dirk, I'm sure we'll come back to some of this during the question and answer session. I'd like to turn now to Lenka.
Yes.
I hope you are around. Yes, I can hear a yes. Will you take all the slides, please, on financial management?
Yes, thank you. I'm ready. So many thanks for the floor. The following slides will be a little bit less colorful and a little simpler. So it will probably be also a little faster. For the co-financing rates, they are regulated by Article 13 of the Interreg regulation. There is a change compared to the current period where we go down slightly in the co-financing maximum, and we go to 80% for the Interreg A, B, and C strands, I mean for the internal programs. And there's a possibility of a maximum 85% or slightly higher for the Interreg D strand for the outermost regions cooperation. So that's for the co-financing rates. I think this is pretty simple, at least for the internal programs. Next slide, please. The technical assistance that is governed by the Article 27 of the Interreg regulation. There is quite a change in the 21-27 programming period, meaning that the technical assistance will now be calculated as a flat rate, which means that there will not be any more a separate priority axis in a program or a specific program, as was the case in 2014-20, and this is not an option in the Interreg programs, it is the rule. So we have the flat rate for the technical assistance. In practice, the flat rate will be then applied as a specific percentage to the eligible expenditure, which will be included in each payment application. So with each payment application, we will apply the percentage and increase then the amount to be paid. And these percentages are defined in the same Article 27. And again, there is a slight differences then for the external programs, but or with the programs with the involvement of the external instruments. But for the internal programs, the percentages are 7% for the internal cross-border cooperation Interreg program strand A, 8% for strand B, again 8% for strand C, and 10% for strand D. Now then there's two extra additions in the article, which says that if the program allocation is between 30 million euros and 50 million euros, then the technical assistance amount will be increased by 500,000 euros, which will be added to the first interim payment claim. And another provision is that if the program allocation is below 30 million euros, then the technical assistance amount and the resulting percentage will be fixed in the Commission decision approving the program. So I mean, we can deviate, and it will be then fixed in the decision. So that's about the technical assistance. Next slide, please. Now, payment applications, those are regulated by the CPR in article, so there are specific articles 85 and 87 that are the most relevant. Here a small difference is that we don't have a specifically labeled final payment application for each accounting year, but the rule is now that the last payment application that is submitted by 31st of July will be deemed to be the final payment application. So if the program submits the last payment application, the payment application in March, and then before the end of July, there is nothing more, the March payment application will be the final one. Then there is a linkage to the assurance package. So the payment applications will not be admissible unless the latest assurance package due has been submitted. The deadlines are the same as in the current period, 15th of February, which can be then extended to 1st of March upon a request. And the reimbursement, currently there is the withhold 10%, so we paid 90% of the amount declared. In the future, in the 21-27 programming period, this has increased to 95%. Next slide, please. Regarding pre-financing, pre-financing is regulated both by the CPR and the Interreg regulation, but the Interreg regulation deviates from the CPR and sets specific rates for the Interreg programs. In 21-22, the pre-financing rate is 1%, 23 to 26, there is 3% pre-financing. As you can see, we clearly talk only about pre-financing. There is no more annual pre-financing and initial pre-financing, it's just pre-financing, which makes it a little simpler. And the clearing of the pre-financing, so for the first 2 years, 21-22, the pre-financing will be cleared annually, so with the next submission of the accounts. Following from 2023 onwards, this will be done at the closure. Next slide, please. I think this is the last slide. This is just a reminder of the N+3 rule that still applies. It's regulated by the Article 99 of the CPR. There is nothing specific in the Interreg regulation. It applies from the year one, so from 2021 to 2026, which means that if program is approved in 2021, the first exercise of looking if the ceiling has been reached is in 2024. On the other hand, if a program is in 2022 approved, then the first exercise is 2025. And for the ceiling, of course, that's both the pre-financing and interim payments submitted that count towards the ceiling established in the financial plan. But the principle of the N+3 rule remains the same. There is no change in that. I think that was from my side, if I'm not mistaken. The next slide, just to check.
Yes.
Yeah.
Yes, you're right, Sulenka. Thank you so much. Thank you for that. Please don't go away. We will have questions at the end. Management verifications. That's Juana?
Yeah, that's me, but I was thinking maybe Rafael wants to say something.
Well, I just make some word and then I will give to the real expert, which is Juana.
Yeah. I thought Rafael was coming for the audit part.
Yeah, no, but it's a package, management verification.
Okay,
go ahead. Yeah.
Go ahead.
No, just to say first, congratulations. I think it's my first participation today, so congratulations to Interac and Natalie and colleagues in D2. You know, we are well known in the EU audit community to organize big events, but I'm really still astonished with the number of participants here. I think it goes beyond all previous records. So congratulations for that. As we need to be at that level, Dirk as well, of course. We need to be at that level. I think we are going to present today probably the most radical simplification we have ever introduced in EU regulation. And I think you know, for the 400 people, that simplification is a joker in any Commission official presentation since the 80s. But here we have a real simplification with this introduction of the EU level audit sample. And I think the best way is to put figures on, and we will ensure a reduction of at least 80% of the audit of operations that the audit authority are doing for ETC programs in the last 15 years. So we are going to get we are going to get the assurance with a very limited number of around 15-20% of audit. So I think this it was, I think, a good effort from the Commission, and I would expect that the authorities will really take it with passion and with interest, and I think OANA will enter then in the practical arrangement. But it's really a big reduction, and I think you will appreciate this. And it's not always that the auditor can give good news in such a forum, but this is, I think, really a good news. As I know, there are a lot of managing authority. Of course, we didn't left the simplification only for the audit authorities. We also have something to offer for the managing authorities. The difference is that while the simplification for audit authorities very much ad hoc for ETC programs, we have a general simplification for management verification. Now, in this case, you need to share with your mainstream people. But now for all which is management verification, we remove the obligation of 100% checks. So this will be something not requested anymore to check every payment claim. And we move to a scheme which is fully risk-based management verification. That means that we put all the power in the hands of the managing authority, and they are really on the capacity to decide how much and where to carry out their management verification. And then they take their own responsibility. But I think it's much better than the current system when the regulation obliges systematically to audit one piece of expenditure after the other. So I think that's the menu, and and of course now I move to Anna Mantok, which is our real expert on ETC, not only ETC but in other matters, that can give a little bit more details in the presentation. Thank you.
Thank you as well. So about management verifications first, I am lucky to present today two of the key simplifications, as Rafael said, and Morey as well in the morning. So management verifications can be carried in case of Interreg by either the managing authority or by the controllers. This is not new, but it is new comparing to the initial proposal of the Commission. This is why it's mentioned in the slides. In case the program decides to use the controllers option, then the member state should identify the controllers. It can do so via three options. Either it can select a national or a regional authority, or a private law company, or a natural person. In case the program decides to use one of the last two options, so either private company or a natural person, certain special conditions need to be observed by these controllers. Namely, they need to be members of an accounting or auditing body, which is either part of the International Federation of Accountants or observe their standards and code of ethics. Another option is for the controller to be registered as a statutory auditor, either in the member state or in the third country and so on, depending on the applicable case. The main simplification for management verification is, as mentioned before, the risk-based approach. So this is applicable for the first time for both on-the-spot and administrative verifications. And in translation, it means that the frequency, the scope, and the coverage of the management verifications will be adapted to the risks which are identified by the program bodies in relation to the categories of costs, in relation to operation, in relation to a multitude of factors which can be taken into account, also based on the expertise gained from previous management verifications as well as previous audits. So after taking all this into consideration, the program needs to establish ex ante and in writing the way the management verifications will be performed. The goal is to reduce the number of controls in levels where the risk of material error is low, but then to increase the number of controls in areas where the risks are high. So we hope to achieve more quality with less effort from a part of the program and reduce, of course, the burden at the level of the beneficiaries. Last but not least, management verifications are to be carried before the preparation of accounts. Next slide, please. This is in CPR, it's not in Interact, but I thought it would be useful to have it also here because there is a slight modification in rules. So in management verifications, we aim to verify that co-finance products and services have been delivered and that the operation complies with the applicable law, program rules, and conditions for support. Nothing new here. Then it splits a little bit between real cost and simplified cost options. So for real cost, we also verify if the expenditures were paid and that the beneficiaries maintain separate accounting for the operational accounting counts and so on. However, when we are talking about simplified cost options, so unit cost, lump sum, or flat rates, the previous paragraph does not apply. Instead, in management verifications, we verify that the conditions for reimbursement of expenditures to the beneficiaries have been met. So this is rather a change and in fact, a simplification for management verifications. Also, in case the program decides to use simplified cost options under Article 88, so those are simplified cost options in relation program European Commission, then also the management verifications and actually audits as well will only focus from everything mentioned above solely on verifying the conditions for reimbursement for the simplified cost options. And that is it for management verifications. We will be back later for audits, I think.
Yes, indeed. Thank you, Rafa and Juana. Audit comes a little bit later. In the meantime, we still have a few other financial issues that Dirk will explain, exchange rate recoveries. Please, Dirk, will you take the floor?
Yes, although this is linked to this financial management, it's my task to present this. For 1420, we had a mixture of rules on the exchange rate for expenditure spent in another currency than the euro. We had the rule in Article 133 CPR, and then ETC actually set out 4 methods. The idea was to be as close as to when expenditure happens by the partner who has to report to the lead beneficiary to the program authorities, and then further to the commission. And so there may be months in between when expenditure was spent and when it is registered. So that's why we had the 4 methods for 1420, and it still raised a lot of interpretation. Now, you see on the right side, the general rule is it should be the month during which the expenditure is registered in the accounting systems of the accounting function. There is no more certifying authority. That's the rule, but in the CPR. But the following paragraph then says, well, there is a derogation in ETC. And the simplification proposed here is there's only one method. And this is one of the methods already existing. You see it on the left, the submitted for verification. We do not distinguish whether verification by the managing authority or by a controller, where programs now opt for this system, which was reintroduced during the negotiations. And the incurred and the reported to the lead beneficiary, these 2 options are down. So it's one method with 2 sub-options according to what is the system of the management verifications in each program. Next. This is the hot potato slide. Nobody else was ready to dwell on this. Now, in 1420, you see in 122 in the CPR, you have all these, and it's not even a complete list of provisions that refer to the member state. The managing authority has to assure that expenditure is regular, that they prevent fraud, irregularities, and when this happens, that they do recover. So the principle was set out, the details, and then there were secondary legislation. The certifying authority had to keep specific records of recovered or to be recovered expenditure. It was also specific parts of the accounts. And finally, in the acceptance of accounts, offsetting was already possible. Now, in the CPR of post-2020, the managing authority still has to prevent fraud and irregularities, but it's not said. You can screen the document for it's only implicit that they also recover. So all these detailed provisions on the left side where the term recover pops up is done. So even in the annex, which is, well, I don't know whether it has a number, but in the negotiation it was called the Annex XYZ, there is nothing on recoveries. And there is also nothing on specific records for the accounting function, because they are not replacing the certifying authority. So there is nothing on this as such. But there is something on offsetting. But what we still have for ETC, and that's on the next slide, a specific recovery chain under ETC. And you see again on the left side, it was quite spread over the ETC regulation. The recital that a clear chain of financial liability in respect of recovery has to be established for ETC, and this is still the case. You see recital 33 of the next ETC regulation, which is copy-paste, plus adding some details on how it should be done, nonetheless for integration of external cooperation. The grant letter had to set out how it works in case of recoveries, and in the new regulation, this is explicitly set. It's an element that the MA has to put into each grant letter. But it has to, that doesn't change. It has to be agreed between the partners how it works, and the chain is still the same. So the MA tries to get recovery from the lead beneficiary. The lead beneficiary then tries to get the money back from the beneficiary or the partners. And what is new, that there is no need for any recovery if there is an amount of less than 250 euro. This is, you see there in Article 52, Para 2, but it's for the program to decide to do so or not to do so. And we had to put it into the ETC because it's not continued on the CPR side. Now, what is more explicit now in the future is what happens if this fails. If the members, if you cannot recover from the lead beneficiary or from the partner, then the member state where this partner is located steps in. This is sort of an assurance, so that for ETC the program budget never loses. There's always recovery. If it cannot be done from the partners that should do it, then the member state or the third country steps in on behalf of that partner. And what is then new is that we clarify that in parallel, the country, once it has paid back to the MA and the MA to the European budget, it can recover from that partner on its territory, going to the national courts, setting out recovery orders, and so on and so forth. But this is their business, and we clarify we don't need any reporting on that. It does not need to be successful. It takes the time it takes. They decide not to do it, whatever. They may recover, but no information towards the Commission. Now, what is completely new is what happens if actually a member state, a partner country, does not pay back. I think this is rather a hypothetical case, but you never know. That's why you have rules when it really goes wrong. So you need to address this. And then this is about recovery as a first step between the Commission and that member state, third country. Then it becomes really serious, because then the EU budget may have that loss. And then in more detail than in our original proposal, it's set out how it works. Then in the second subparagraph, when it is with the member state, and in the third subparagraph, offsetting with third countries, but that's for next week. And it's a model we had already more or less under the current ENI CBC rules. And I saw the questions, yeah, but for ETC, we don't know what is the share of a member state. That's true, but we know the amount normally, what has to be recovered, what has to be paid back. A beneficiary somewhere bought a Mercedes for well, they exist, 100,000 euro, and this is not eligible. So these 100,000 euro have to be paid back. And if it's, as I said, if it's a third country, we had rules already. But even for any region in the Union, that region has an ERDF program, a mainstream program. That's how it is set up. I cannot tell you how it will work in the practice, because we have never done this. And so, as some people say, provisions for the future are difficult, in particular when they are linked to the future. And now I hand back to Natalie.
Thank you, Dirk. A bit convoluted, sorry. This chain for recovery, but I'm sure we will all have to digest that, think a little bit, and maybe we come back to that, not necessarily in the question and answer session, but possibly a bit later. Session 4 now ends with its last big topic, which is audit, and I welcome back Oana for that.
Thank you, Natalie. In principle, no change related to group of auditors. They were there before, they are here now, not explicitly mentioned in the initial proposal of the Commission, but are present now in the final version. Also, no change in the fact that the annual opinion of the Audit Authority should be submitted by the 15th of February. However, there is a slight difference, and this is why I've inserted this slide. So by the 15th of February, annual opinion on completeness, veracity, and accuracy of accounts, and also on the management and control system. However, on the legality and regularity of expenditure, this is not required from the audit authorities in case the program is part of the common sample. And we will get back to see when the program is part of the common sample and what is the common sample, the new big simplification. But in order to save time and to integrate questions in the slides related to the last bullet, annual opinion on management and control system, this refers to the entire Interreg program. So we had a question at the registration, what happens in case new partner states come in? So at the moment when the Audit Authority expresses its annual opinion, it should do so for the entire Interreg program, so including eventual new partner states. So this is the moment when the Audit Authority should express its opinion on the entire system, not just the managing authority. So any changes should be also reflected. Next slide, please. There is no more audit for designation because there is no designation. However, there is a 21-month deadline for the Audit Authority to carry its work for newly identified managing authorities and accounting bodies. 21 months from the moment of the EC decision. So this is a new provision. This is work which needs to be carried. Also, system audits remain. They are to be submitted to the European Commission as soon as the contradictory procedure with the relevant auditees is concluded. Also a new provision. Related to a question as well, are system audits gone in linked also with the provisions in CPR of Articles 77 and 78, which are enhanced proportionate arrangements? The short answer is no, because Articles 77 and 78 do not apply to Interreg. There is a list of articles which do not apply. So neither single audit do not apply to Interreg. This is because we already have our own huge simplification, which is common sample. So this is why system audits will be in place. We expect them, we hope them that the audit authority takes them into account when drafting their audit strategy based on the risk assessment. Next slide, please. Diving into common sample. Okay, how does the common sample work? First, the program sends the data to the European Commission by the 1st of August. Then we have a month to analyze the data and to establish the sample. So by the 1st of September, the audit authorities will have the sample available at their level. They can already start the work. However, going back a little bit below the lower level, in order for us to be able to draw the sample, we need the data provided by the program to be complete, reconciled with the expenditures which are included in the accounting year, and also for the data to have no mistakes in it, basically. So to be full and with no mistakes. If these conditions are fulfilled, then we move to common sample. If they are not fulfilled, then the audit authority will be forced to go back to the classical audit of operations, Article 73 in CPR, with all the rules and so on, including the opinion on legality and regularity of expenditures. But assuming that the program has submitted the data fully and completely with no mistakes, we draw the sample, we communicate the sample to the audit authorities, and then they start doing the audit work. When the work is performed, it is submitted to the European Commission by the 15th of February. It is important to note that in the package which is submitted to us, the financial corrections applied by the Interreg program authorities for any individual irregularity detected in the audit work should be mentioned already in the package submitted by the 15th February. And we will see why in the next slide and the final one. Because we calculate initially the total error rate. So this is calculated at our level and it is global for all the Interreg programs. And we have two scenarios. In case it is below 2%, everything is good, no more work requested from audit authorities and the programs. However, in case the total error rate is higher than 2%, then we need to calculate the residual total error rate. And this is where the previous highlight related to financial correction comes into place. We need to know all the financial corrections which were already operated in order for us to be able to calculate the residual total error rate and hopefully bring it lower than 2%. However, it might be a case that the residual total error rate is higher than 2%. To be honest, from the historical data, and this is basically the reason, the rationale for which this measure was proposed for Interreg, traditionally, in general, the residual total error rate for Interreg program does not exceed 2%. So we hope that won't happen. But in case it does happen, the mechanism is as follows. We, the Commission, can ask the audit authority, can assess the situation, and may ask the audit authority to perform additional work in order to clarify the situation. After the audit authority carries this additional work, the results are communicated to the European Commission. Oh, and I forgot to mention that the work performed by the audit authority should be focused by the affected programs. So not overall, just for the affected programs of which were linked to the residual total error rate above 2%. So after this additional work is provided to the European Commission, we analyze it, and we may also request financial corrections, which are to be applied in line with the general rules foreseen in CPR, so Article 97, but also in this case, they refer only to the affected programs. So basically that was it in the nutshell for audit of operations. Thank you.
To conclude really with a few words before we all go for a deserved glass of wine, I would say, or beer. So we hope that you have been able to take a lot from today, and especially clarifications on doubts or areas which were maybe a little bit fuzzy because of their recent introduction in the draft regulation. We wanted to say that we believe that as this new period starts, there are very genuine simplification offers in the regulation, both for program authorities and for beneficiaries. I can only stress the importance of the disappearance of the certifying authority. It's not just that the name certifying authority disappears, it's really much more than that. It's about deleting what the certifying authority did. In many cases, there were some additional controls done at that level, which really have to go, and only the accounting, the strictly accounting function remains. I think this is really, really important to understand. The single audit approach that Oana has just described, it will significantly reduce work for the audit authority and consequently for the managing authority. The risk-based approach to verifications, I think, is also really a big step forward. It does mean, however, that you do need to invest ex ante, i.e. now, in methodologies for identifying risks and mitigating measures, indeed, but in the long term or in the medium term, it would certainly free resources that were extensively used for 100% verifications in the past. And I would remind us of Maury's words this morning that these simplifications really are meant to redirect resources for content work as opposed to administrative work. So we very much hope that you will make use of these simplifications to the full and exploit their potential.